Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. We have a very general question today from Mary. Alan, I follow the site Seeking Alpha as well as your BCI site. Can you give your thoughts on how the BCI methodology seeks to beat the market? I'm really enjoying your material, and it's signed, thanks, Mary. Okay, well, we got the term Seeking Alpha in there, so let's start off with a few fundamental definitions before we respond to your question, Mary. First of all, what is alpha? Well, it's the excess return, also known as an active return, where an investment generates more than or above and beyond a market index like the S&P 500. That is what is meant by seeking alpha, getting a higher return than that benchmark. Now, the term beta relates to the volatility of a security, stock or ETF, or even a portfolio in total, compared to the overall market. And most people refer to the S&P 500 as the overall market. So, for example, if stock XYZ has a beta of 2, and the S&P is up 4% in a particular time frame, one would expect XYZ to be up 8%. On the other hand, if the market is down by 4% and XYZ had a beta of 2, one would expect the returns on XYZ then to be down 8%. So that's how it works with beta. But when we're seeking alpha, let's relate it to the overall market. What our goal is to beat the overall market on a consistent basis. So if the market is up 4%, any returns above and beyond 4% would be considered alpha. So we're seeking alpha, we're seeking to generate a higher return than the overall market in a particular time frame. So let's now hone in on the BCI methodology, because that's what we're really all about. We're about seeking alpha. We're about beating the market on a consistent basis. So how do we do that in the BCI methodology? Well, right at the top of our list, and probably the most important, is that we are lowering our cost basis by selling options. This is not rocket science, ladies and gentlemen. This is simply how it is. We have a debit when we buy a stock, and we have a credit when we sell an option. And that credit lowers our cost basis. Now, in addition to that, we use the 3 required skills that must be mastered when we're using covered call writing. And those skills are stock selection. What underlying are we going to use in our portfolios before we sell the options? Then option selection. Which options are we going to choose from? Options have different strike prices, different expiration dates. By selecting the most appropriate based on overall market assessment, chart technicals, and personal risk tolerance, we'll continue to throw the odds in our favor. And finally, position management. How do we manage our positions once we enter them? Now, frequently we don't have to do anything at all, but there are times when action is required. So those are the 4 main ways we seek alpha in the BCI methodology: lowering our cost basis, and then mastering and executing the 3 required skills. Now let's first focus on the what I consider the most important one, which is lowering our cost basis. And I'll give you an example, first the generic one, and then a real life example. So let's assume stock XYZ is trading at 48. Okay, we spend $48 a share. One contract, 100 shares, $4,800. And then we sell the $50 call option for $1.50, or $150 for the contract. Now, our cost basis in this case is lowered from 48 to 46.50 by selling that option. Now, our next door neighbor who bought the same stock at 48 has a cost basis of 48. So you could see that by using covered call writing, buying the stock and then selling the option, we are lowering our cost basis. Now, the disadvantage of covered call writing in this scenario is that the upside is capped at 50. So the price of XYZ moves above 50, we cannot participate in that additional appreciation over $50 a share. But we've had a very nice return if we bought it at 48 and sold the $50 call 1 month out. Very, very nice return. Okay, let's now have a real life example of that very same thing of lowering our cost basis. And here we're going to use Boot Barn, trades on the New York Stock Exchange under the ticker BOOT. Now, at the time that I made this screenshot of the option chain for Boot, it was trading at 42.29. And we're going to look over at the 45 out of the money strike 1 month out, which had a bid price of $1.15, as you could see on the right side of that double-ended red arrow. So if we generated $1.15 after spending $42.29, our cost basis is lowered to $41.14, improving our chances of a successful trade. And once again, share appreciation is capped at 45, but if the price of the stock moves to 45 or higher, we've had a hugely successful 1 month return. Okay, so let's move on past lowering our cost basis and look at what we do under stock selection. Now, rather than just picking any old stock or picking every stock in an index, we're going to zero in on stocks that we're going to screen from 3 different perspectives: fundamental analysis, earnings and sales growth, technical analysis, and then some common sense principles. So fundamental analysis, sales and earnings growth, we use a few IVD screens plus a couple of our own. And we add in things like unbalanced volume or median analyst ratings. The material is in my book as to how we screen stocks from a fundamental perspective. But once again, here we're throwing the odds in our favor by selecting only elite performers from this fundamental perspective. Now, technical analysis is the second prong of our stock screening approach. And here we use 4 parameters. Feel free to use the ones that you're most comfortable with, but I'm happy to share with you the ones that I used and have been using successfully for covered call writing over the past 25 years. And those are exponential moving averages, which show trend, the MACD histogram, which is a combination of trend and momentum, the stochastic oscillator, which is also a momentum indicator, and finally volume, which we use to confirm the other indicators. And also we look for divergence. So for stock prices going up and volumes going down, there's a potential red flag for a reversal of that trend. So those are the 4 technical parameters that I use. They're discussed in detail in my books and DVD programs. And finally, common sense principles like average trading volume. We don't want to use underlying stocks that are illiquid or even options that are illiquid for that matter. We want to be diversified, and there are several other common sense principles that we want to hone in on before we enter a trade. So that takes care of stock selection. We already went through lowering our cost basis. Let's have a quick look at option selection. Now, options, we have 2 decisions to make: the moneyness of the option and the expiration date. Let's start with moneyness. And that's where the strike price is, the price we're agreeing to sell our shares for, as it relates to current market value. So we have an in-the-money strike. An example would be a stock trading at 56 and we sell the 50 call. That 50 call is in the money, lower than current market value. It's the most conservative approach to covered call writing. It's basically a defensive position, but we're still generating significant time value profit. At the money strike, example, a stock trading at 30 and we agree to sell it for 30. That's a bullish approach to covered call writing. And finally, the out of the money strike, where we buy a stock at 48 and agree to sell it for 50. And that's the most aggressive approach to covered call writing, which allows for the potential of 2 income streams, one from option sale and the other from share appreciation from current market value up to the strike price. And now, as far as the expiration date, we have a lot of choices: 1 week, 1 month, multiple months, multiple years in some cases. My sweet spot are 1 month options. That's where I've had the most success, although we do have many members of BCI that prefer weeklies. You can make money on both. Finally, with options, we look at the premium returns, because setting up an initial time value return profit is important, because if we're too high for our returns, we're dealing with very volatile underlyings and therefore high risk. So we don't want to take a low risk strategy like covered call writing and convert it to a high risk strategy by using very volatile underlyings. My sweet spot, 2 to 4%, and that will generally keep us out of trouble. In bull markets, I may go as high as 6%, but never higher. Okay, so we've been through lowering our cost basis, fundamental analysis, which includes selecting the stock under fundamental analysis, technical analysis, and common sense principles, and then option selection. Finally, position management. Excuse me again. Bit of a head cold, folks. Okay, position management, exit strategies. They all start the same way, by buying back the short call. Now, frequently we don't have to do any exit strategies at all, but when we do, it's important that we execute them. The price of the stock goes way down, goes way up, a dividend coming up, an earnings report coming up, strike is in the money at expiration, and we don't want to give up our shares, so we initiate these exit strategies. We could roll down to a lower strike. We could look to hit a double, buy back the option and resell it when the price recovers. We can close both legs of the trade if the price of the stock is underperforming the market. We could close the entire position mid-contract and enter a new position if the time value cost to close is very small. We could roll options out or out and up as expiration approaches. There's so much we could do, and we have to be prepared with our position management skill set prior to entering any trade. So, as you can see, lots we can do when we're seeking alpha. Let's review. We're lowering our cost basis by selling options, covered call writing. We're selecting stocks with elite fundamentals, bullish chart technicals, and meet our common sense requirements. We're selecting the most appropriate options based on overall market assessment, chart technicals, and personal risk tolerance. And finally, we're executing our exit strategies when appropriate. So, Mary, I hope you could see that in the BCI methodology, we are using every tool available to us as retail investors to seek alpha, and then to successfully take that alpha to become elite covered call writers and achieve the highest levels of success. So, Mary, thank you very, very much for that question. It's an important one, and it gives me a chance to show what the BCI methodology is all about. So, as always, I hope you enjoyed this video and benefit from it. This is Ellman, the Blue Collar Investor. Take care, everybody.